It's pretty clear that economic growth is slowing. Certainly the economy is weakening. I think the Fed carries some of the can here. So if you're waiting for inflation to get back down to its target before starting to take your foot off the monetary brake, as it were, then you've left things too long.
Is the US heading for a recession? Volatility on global stock markets this week showing uncertainty over the American economy. Let's ask Neal Shearing, chief economist at Capital Economics. Neal, thanks for joining us. What signals out of the US have investors so worried?
Well, I think there's been two things that have happened over the past few days. On Thursday, we got a report called the ISM Manufacturing Report. This is a survey of the biggest manufacturers in the US, and that was pretty bearish. That reported that manufacturers were seeing output falling in the month of July. And then that was followed by non-farm payrolls, the July employment report, which is really the most important piece of economic data that the markets globally look at. This is about the health of the US economy, the US labour market, and by extension the US economy and the global economy, given the US's role as the consumer of last resort in the global economy. And that came in pretty weak. So the US created fewer jobs in July. The unemployment rate in particular went up to 4.3%. It's the highest in this cycle and more than people are expecting. And it triggered what's called the so-called SARM rule. This is a rule that was invented by a US academic called Claudius Sarm that suggested that if unemployment goes up by a certain amount in the cycle, then typically a recession follows in the US. So in triggering that then got the market kind of in a frenzy about US recession risks, that the Fed's kept rates for too high for too long. The US economy is, of course, the world's biggest economy, most important economy. So if that's experiencing trouble, then the rest of the world is a big deal for the rest of the world. And then that fed into this collapse in global stock markets on Friday that then continued into Monday.
Okay, so there's a whole bunch of kind of uncertainty over the state of the US economy, or where it's going to be going, because there's a worry that demand is going to be weakening. But it's kind of confusing. There's so much conflicting information. On the one side, you have a Fed survey of banks showing credit conditions for households are stabilizing, demand for most types of consumer loans is improving. But on the other hand, you have the US Consumer Confidence Index, where their analysts say that Americans still appear to be concerned about elevated rates and elevated prices. So which story are we supposed to believe about whether demand could weaken in the US?
Yes, you're exactly right. And take a step back, and this whole cycle has been, for want of a better word, weird. It's because of the pandemic. So we've seen these big shifts in manufacturing demand for manufacturing goods through the pandemic that then collapsed as lockdowns were lifted. Likewise, we saw services demand crater during lockdowns and then surge once lockdowns were lifted. So the whole kind of ecosystem of data that economists look at to get a handle on the cycle has been turned upside down by the pandemic and the distortions it created. So it becomes very, very difficult for economists to track the economic cycle, but also, of course, central bankers, investors, governments as well. Now, the question was, where's the US economy heading? My sense is that it's not quite as in quite as a difficult position as the market moves over the past 48 hours might suggest. I mean, it's pretty clear that economic growth is slowing. That's the whole point and purpose of the Fed tightening monetary policy. It wants to try and squeeze demand in the economy and therefore get inflation down. That's the way that the mechanism of the channel through which monetary policy operates. So the economy is slowing. Is it on the cusp of recession? Possibly, we might be heading in that direction, but if so, I think it's a mild recession. Is it already in recession, as some people fear, and does that warrant the Fed stepping in with emergency interest rate cuts and really big aggressive action? No, I don't think so, not at this stage. So certainly the economy is weakening. Is it possible that the Fed kept rates too high for too long? Yes, I think it probably is. Could there be a mild recession? Possibly, but probably not my base case. Is this a kind of 2007-8 style meltdown and global financial crisis? I don't think so.
Okay, so interesting there that you're talking about the accusation that the Fed has been too slow in its response, that the economy may be weakening, its response to that weakening. So does the blame lie with the Fed, or is it just such a tricky and complex issue that it's really hard for a central bank to react to that?
Look, I think the Fed carries some of the can here, yes. And it's not just the Fed, by the way. I think other central banks are culpable. Throughout this cycle, weird though it is, as I say, it's been difficult to track, but I think they kept monetary policy too loose through the pandemic and were too slow to raise interest rates in response to higher inflation in 2021. And then back in the 2021, start of 2022, and then having fallen behind the curve, they've had this mantra, not just the Fed, all central banks, including the ECB, this mantra that we're not going to start to really take our foot off the brake until we see signs that underlying inflation is back at its target rate, 2% typically. The problem with that approach is that inflation is what economists call a lagging indicator. It tends to move behind the economy. So the movements in the economy lead movements in inflation. So if you're waiting for inflation to get back down to its target before starting to take your foot off the monetary brake, as it were, then you've left things too long. So I think the whole approach has been somewhat deficient. But as I say, this has been an incredibly difficult cycle to call because it's principally, normally in economic cycles, it's about how demand shifts in the economy, what happens to consumer spending and business investment. This cycle has had an element to that, but it's also been about really substantial dislocation on the supply side of the economy and labour markets, with firms shutting down to opening up during the pandemic. Big disruption on the supply side of the economy caused by the pandemic. So central banks have erred, but I think we have to give them some leeway. And we have to acknowledge to some extent that this cycle has been a difficult one to call.
Okay, but part of the fear now is that if there is an increasing likelihood of a recession, if the data starts to show that the Fed may enter into a period of rapid, continuous rates cuts. Do you think that that's going to happen? Does that seem likely to you? And that what would be the fallout of that?
Well, there's certainly speculation and calls in markets for the Fed to convene an emergency meeting to cut interest rates between now and its next meetings due in September. I think if they were to do that, then I think actually that would risk making the situation worse. The markets would interpret that as the Fed knows something that we don't. What on earth's going on here? And so it could risk exacerbating the problem. So my sense is that the Fed will try and there's a series of speeches by officials by the Fed over the next week or so. They'll try to settle things down, calm the markets down through verbal intervention in those speeches, through statements to the press and so on and so forth, rather than convene emergency meetings to start to cut interest rates. The question is, would cutting interest rates at this juncture be a mistake? And almost certainly not. I mean, inflation is back under control, particularly in the US. And so that gives the central bank some room for maneuver. And of course, don't forget that not just in the US, across Europe and in the UK as well, interest rates are still in what economists would call restrictive territory. We have interest rates at 5.25% to 5.5% in the US. The neutral rate, so the rate at which interest rates are neither kind of accommodative nor restrictive in the US, would be something around the kind of 3 to 3.5 rate. So they can cut interest rates by quite a long way in the US without necessarily giving stimulus to the economy. It's just giving less restraint, becoming less restrictive. And I think the same is true in the Eurozone, the same is true in the UK. I think it's an important point to keep in mind. So with inflation kind of back under control, I think it would be a mistake not to be lowering interest rates at this point. If I was on the FOMC in the US, and for that matter, the ECB's Governing Council or the Bank of England's Monetary Policy Committee, I would have been cutting interest rates a bit sooner.
Interesting. We've seen also that, of course, the volatility that has rippled through Asia and Europe on the stock markets just goes to show, of course, how much close attention they're paying to the US economy. But if the US were to go into recession, even just a short recession, maybe not as short as we saw during the pandemic from like February to April in 2020, but how much of a ripple effect would this see? Would this be a significant shift, or would this be perhaps not as bad as feared?
Well, I think it's important to distinguish between different types of recession. You mentioned the recession following the pandemic. I mean, that was a really short but incredibly sharp recession. So in Europe, we had some of the steepest falls in output ever recorded. So very, very deep recession, but V-shaped, very short. Then you had the recession after the global financial crisis, and in and around the global financial crisis, deep by historical standards, not quite as deep as that after the pandemic, but very protracted. And of course, then the knock-on effects in Europe with the European sovereign debt crisis. And then contrast that with the recession that the US experienced in 2001, when the dot-com bubble burst, which was over pretty much before you knew it. Unemployment rose a bit, industrial production fell a bit, there was 1 quarter of negative GDP, but by the back end of 2001, the economy was growing again. So I think my sense is that if the US is heading for a recession, it's much more likely to be that kind of 2001 style recession that, you know, is perhaps over before you know it. It's short, it's relatively shallow, and it's certainly not something that looks like 2007 or 2020. Then the question is, what does that mean? Well, for the real economy and for the rest of the world, if the US proverbially catches a cold and the rest sneezes and the rest of the world catches a cold, the US is the world's largest economy. It is its consumer of last resort. So if the US slows, then it has implications for other economies. However, if it's a mild recession of the sort that I've just sketched out, then I think those implications are perhaps less severe. The consequences are less severe than, say, 2007, where it's spread throughout the global economy. Contrast it too with the market fallout. The economic fallout for other economies might be, that there might be some, but it might be less severe. The market fallout, I think, everywhere, if the US economy was to experience a recession, would be more significant. We'd see equity markets tumbling across the world. We see a lot of the air coming out of the tech bubble. I think there's still more air to come out of that. And so I think it's important to distinguish between types of recession on the one hand, but also the impact that has on other economies, but also other markets.
Okay, I just want to pick up on that kind of tech bubble point there. So one of the topics that's been hotly discussed is whether there's an AI bubble forming, investors getting too excited about AI projects which won't become significantly profitable. Do you see this as a big risk?
I do. I think that's exactly what's happening, and it's possible that bubble's been pricked by events of the past few days. But my sense is that if you look at previous bubbles, it's probably got a bit further to inflate. Actually, we've not yet quite reached kind of peak mania around AI. Now, that is not to say that AI will not deliver substantial economic gains for the world. I think it will. I think it's a transformative technology. I think we can think of it along the lines of steam power, electricity, the internet, the digital and computer revolution in the 1980s and 1990s that transformed the way that we work, that transformed productivity in advanced economies. I think AI is going to fall into one of those kind of transformative, what economists call general purpose technologies, that has really substantial economic consequences and positive economic consequences. However, it is also the case that when you look at these transformative technologies, bubbles do tend to form around them. And the reason is that investors try to crystallize the perceived gains from these technologies ahead of them actually manifesting themselves in the real economy. And that's certainly what happened in the dot-com bubble at the late 90s, early 2000s. I suspect something similar is playing out. And interestingly, if you remember back then, cast your mind back to the mid-1990s when the dot-com bubble was starting to inflate, there was quite a big correction in 1998. Caused in part, actually, similarly to today, when the yen carry trade unwound, it brought down a big US hedge fund called LTCM, and the Fed ended up intervening, cutting interest rates. But then the dot-com bubble just inflated even further, and it wasn't until the early 2000s that it burst. And I suspect we might be seeing something similar play out with big tech. That is to say, some of the air coming out of the bubble, once things settle down, then some of the hype will start to start again, and the bubble has a bit further to inflate before it finally pops.
Well, it's been fascinating having your expertise on this, your warning of a potential, possible short, sharp shock in the US economy to come. Neal Shearing of Capital Economics, thank you very much.
Thank you.